Over the last 50 episodes of Earnings Per Page, we have explored the fundamental laws of money, from the psychological traps of leverage to the centuries-long cycles that shape global reserve currencies. But if there is one constant across every financial market in history, it is that capital always migrates toward the path of least resistance and highest perceived yield. When interest rates stay elevated and traditional commercial banks tighten their lending standards to protect their balance sheets, where do high-yield borrowers turn? They move into the shadows. Over the past several years, Wall Street has witnessed an unprecedented explosion in private credit, direct lending from private equity funds, asset managers, and shadow banking entities outside the traditional regulated banking system. Today, private credit has swelled into a staggering $1.7 trillion asset class, financing everything from corporate buyouts and software firms to commercial real estate development. However, legendary distressed debt investor Howard Marks, co-founder of Oaktree Capital Management, has spent over 40 years studying credit cycles, market psychology, and asset pricing. In his timeless investment classic, The Most Important Thing: Uncommon Sense for the Thoughtful Investor, Marx warns that the most dangerous moments in financial history do not occur when investors are panicking. They occur when investors become overly comfortable, driving capital into complex, illiquid structures in pursuit of extra yield without demanding a proper margin of safety. Welcome back to Earnings Per Page. Today, for our milestone 50th episode, we unpack Howard Marks' essential risk management framework, dissect the mechanical realities of the $1.7 trillion private credit boom, and examine why understanding credit cycles is the ultimate key to preserving wealth. To understand how financial bubbles form in debt markets, Marks begins with a concept he calls, second, level thinking. First, level thinkers look at the surface of a market trend and ask simple, reactionary questions. Is this asset class yielding 11% while bank deposits pay 4%? If so, buy it. Second, level thinkers, however, evaluate the complex underlying dynamics that first level thinkers ignore. They ask what hidden risks must be taken to generate that extra yield. Who is borrowing this money? Why can't they obtain funding from traditional banks? What happens to their debt coverage if interest rates stay sticky? And how liquid is this investment if conditions deteriorate? Marx explains that risk in financial markets is inherently counterintuitive. Most people believe that high risk goes hand in hand with high returns. But Marx clarifies that if high-risk assets reliably generated high returns, they wouldn't be high risk. True risk is the probability of capital loss when assumptions fail. The greatest risk does not come from low-quality assets when everyone knows they are low quality, because low-quality assets get priced cheaply to account for that risk. The greatest risk occurs when high-risk, illiquid assets are marketed as safe, stable, and predictable, driving massive capital inflows from yield-starved investors who stop asking hard questions about underlying collateral value. To grasp why Howard Marks and institutional risk officers are closely analyzing private debt, we must examine how direct lending operates. Historically, when a mid-sized corporation needed $200 million to fund an acquisition or expand operations, it had two options: issue corporate bonds to the public market or secure a loan from a commercial bank. However, following banking regulations like Dodd-Frank and Basel III, traditional commercial banks were subjected to strict capital reserve requirements, making it significantly harder for them to hold higher risk, leveraged corporate loans on their balance sheets. Enter the private credit market. Private equity firms, hedge funds, and specialized asset management shops stepped in to fill the gap. Rather than acting as intermediaries that collect deposits and issue regulated loans, private credit funds pool capital directly from institutional pension funds, university endowments, sovereign wealth funds, and accredited individual investors. They lend that money directly to private middle-market companies, often backed by private equity buyouts, at floating interest rates. For years, this appeared to be a win-win arrangement. Corporate borrowers secured fast, customized capital without public regulatory scrutiny, while institutional investors locked in attractive 10 to 12% annual yields in an environment where government bonds paid very little. However, applying Howard Marks' cycle framework reveals critical structural vulnerabilities currently accumulating beneath the surface of the direct lending market. The first fragility is floating rate debt burden. Most private credit deals are structured with variable or floating interest rates pegged to benchmark yields. When baseline interest rates rise and remain elevated, the interest expense borne by corporate borrowers escalates dramatically. Middle market companies that borrowed heavily when baseline interest rates were near zero now face significantly higher annual debt servicing costs. If a company's operating cash flow fails to grow at the same pace as its interest bill, its debt service coverage ratio compresses toward dangerous levels. The second fragility is illiquidity and valuation opacity. Publicly traded corporate bonds and stocks are repriced by open financial markets every second of the trading day. If credit risk rises, public market prices drop immediately, reflecting reality in real time. Private credit assets, by contrast, are non-traded illiquid loans. They are valued periodically through internal manager models rather than open market discovery. Marx points out that when assets are marked internally rather than traded publicly, it creates an illusion of low price volatility. Investors feel comfortable because their account statements do not show sharp drawdowns, but that perceived stability often masks underlying fundamental deterioration in the borrower's solvency. The third fragility is payment in kind, i.e. structuring and refinancing risk. As corporate borrowers struggle under elevated interest outlays, an increasing number of private credit agreements are utilizing payment in kind amendments. Instead of paying their monthly interest in cash, borrowers add the interest obligation directly onto the principal balance of the loan. While this prevents an immediate formal debt default, it compounds the total debt burden even faster. When those massive loan balances mature over the coming 3 years, borrowers must either refinance their debt at prevailing market rates, find new equity injections, or hand the keys of the business over to the private debt lender. How should investors position their portfolios when credit markets reach mature, late-cycle conditions? Marx outlines clear principles in the most important thing for managing risk when market cycles shift. Be willing to accept lower yields when risk is high. When market yields look attractive on the surface, but underlying credit protection weakens, forcing your portfolio into higher risk just to maintain arbitrary return targets is a recipe for severe capital loss. Preserving capital during late-stage debt cycles is far more critical than reaching for the last dollar of yield. Focus on liquidity and balance sheet quality. In calm financial environments, illiquid assets trade at a premium because investors prioritize yield over flexibility. But when credit markets tighten, liquidity becomes the most valuable asset in the world. Holding liquid, high-quality assets allows you to survive market drawdowns and take advantage of distressed fire sales when over-leveraged borrowers are forced to liquidate. Insist on a wide margin of safety. Never build an investment thesis that relies on perfect economic conditions, perpetual cheap refinancing, or uninterrupted revenue growth. Demand low debt ratios, strong real cash flow coverage, and robust collateral protection before allocating capital to credit assets. Understanding Howard Marks, the most important thing equips you with a rational, disciplined lens for evaluating financial markets when everyone else is chasing short-term yields. To summarize Mark's core principles into 3 actionable takeaways for your wealth strategy, practice second-level thinking. Look beyond headline yields and marketing claims. Always ask what macro assumptions must go right for an investment to succeed, and what happens to your principal if those assumptions fail. Respect the credit cycle. Debt cycles move from aggressive lending and loose standards to sudden credit tightening. When direct lenders begin relying on financial engineering like payment in kind debt to avoid default disclosures, late cycle risk is active. Prioritize risk control over risk bearing. True investment success is not defined by how much money you make during market booms, but by how well your portfolio retains value when credit cycles turn. Building a durable margin of safety is the single most important element of long-term wealth compounding. Thank you for celebrating 50 episodes with earnings per page. We appreciate every single one of you who tunes in weekly to save hours of reading and extract the financial insights that actually move the needle. Don't forget to hit the subscribe button, drop a comment below on how you see the private credit market unfolding, and keep earning your dividends, one page at a time.